Assalamu alaikum wa rahmatullahi wa barakatuh, and good evening. On behalf of Minara Chamber of Commerce and 27-4, we welcome all those in physical attendance this evening, as well as our online audience to this workshop, which has been titled, Why Investments Are Important for Business Financial Stability. I'll start off with a small, humble supplication, beseeching Almighty Allah that He blesses us in our deliberations, and that He make the outcome of our deliberations one that will impact positively on our wealth, ensuring that it grows, that it's blessed, and that it is preserved, and that it is beneficial for us individually, as well as for our communities, for the Ummah and humanity, currently and for generations to come in perpetuity, inshaAllah. Ameen. Let me call upon Zahida Adam Kara from the Minara Chamber of Commerce to do the official welcome for this evening's program.
Assalamu alaikum wa rahmatullahi wa barakatuh. Thank you. On behalf of the Minara Chamber of Commerce, I would like to extend our sincere thanks to 27-4 for partnering with us on this incredible event. We also appreciate all attendees and members for joining us, making this one of the first of many successful events in the region. We look forward to continued collaboration and many meaningful business engagements in the future. Thank you.
Shukran for that, Zaida. Let me take the opportunity to introduce myself. My name is Sulaiman Rawat. I'm an Islamic scholar, public speaker. My background is in Muslim media. Alhamdulillah, in December that passed, that marked 20 years as the breakfast show presenter on Radio Islam International. Alhamdulillah. I also do some work on other Muslim media platforms and mainstream media platforms as well. And Radio Islam is glad and proud to be the media partner for this event. You can catch us here in Gauteng on the radio medium wave 1548 and nationwide as well as internationally on the Radio Islam app, which is quite easy to download on your mobile phone. Let me also introduce the panelists for this evening. To my immediate right, we have Hafidh Amin Hassan, Hafidhul Quran, banker by day. They say car guy by night. I don't know that car guy by night, what does it mean, but maybe he'll explain that at some point. And student of everything in between. He's the head of Sharia banking at the Standard Bank Group, has over a decade of experience in the Islamic banking sector. He successfully founded and launched the Sharia banking for the largest bank in Africa, Standard Bank by assets. He holds a diploma in Islamic banking and a postgraduate diploma in Islamic banking and law. He is recognized for his innovative contributions to the field, including the introduction of the first Sharia-compliant charge card in the region and the first unsecured working capital solution in the region, and for being the technical lead on South Africa's inaugural ZAR-dominated sukuk. So that's Hafidh Amin Hassan. Then we've got, is it Hafidh as well? Ridwan Kaji? Nearly Hafidh. Okay, so there's like a Khatmul Quran Dawat loading. Okay. He's a senior analyst at 27-4 Investment. He's one of the investment managers. He focuses on supporting the Agraria strategy, Africa's first sustainability-linked sukuk listed on the JSE. He's an investment committee member within the Sharia real estate strategy of the firm. He supports all the Sharia aspects of the business. He has represented 27-4 on various forums related to Islamic finance. He's a qualified chartered accountant with over 12 years of expertise in private equity, financial analysis, deal structuring across sectors such as financial services, agriculture, and real estate. And then we've got Amina Nagdi, Senior Managing Director at FTI Consulting, based in Johannesburg, qualified CA, over 18 years of experience in providing buy-side and sell-side due diligence assignments across all industry sectors, working for both strategic and financial buyers to local and international clients. Industry experience includes logistics, industrial, retail, telecommunications, insurance, mining, private equity, and capital markets. Amina has served clients in several countries across the rest of Africa, including Kenya, Nigeria, Botswana, the DRC, Zambia, and Mauritius. And she has also performed independent business reviews across Malawi, Mozambique, Swaziland, Botswana, and Kenya. Now, as we know, the topic for this evening's discussion is why investments are important for business financial stability. And allow me just to make one or two introductory remarks before we get into the discussion with our panelists. From an Islamic perspective, I mean, if you look at the Islamic system of commerce, it's designed to support the circulation of wealth. Hoarding of wealth is something which is frowned upon in the Sharia. So if you look at the different concepts, waqf, the endowment, or hiba, gifting, wasiya, where you make specific bequests to specific beneficiaries in your will, or inheritance in itself, it's all meant to facilitate the circulation of wealth. And if you decide to hoard your wealth, then zakat will apply. So it's forcibly then circulated. Therefore, investments then enhance the natural order of dependency. And when those investments are underpinned by ethics, then it improves the moral fiber of society. So in a nutshell, Sharia does not only look at preservation of wealth, but it simultaneously looks at the growth of wealth. And it's part of the aims and objectives. It doesn't only promote preserving your wealth, but also the growth of your wealth and the enhancement of your wealth. As an example, if you look at the verses in the beginning of Surah An-Nisa, where guidelines are given to the guardians of the orphans. And one of the specific guidelines is that invest the wealth of the minor. Don't just preserve it, but invest it. Different verses of the Quran kind of give indication, strong indication. If you look at the verses pertaining to charity, where Allah talks about the seed which grows 7 years, and in each year there's 100 grains. The commentators have written that this tells us that financial investment, when nurtured with strategic planning and patience, will yield greater results in the long term. Allah says, for example, وَلْتَنْظُرْ نَفْسٌ مَا قَدَّمَتْ لِغَدٍ, that every soul must look at what he has put forth for tomorrow. Now there's the greater meaning, which means you must prepare for the real life, which is the life of the akhirah and the year after. But there's also the more immediate meaning, that in terms of your financial stability and the overall well-being of yourself and your family, invest, have foresight. Don't only live for today, but look at what you are preparing and putting in reserve for tomorrow. I'll just conclude my thoughts. You know, recently I was doing some research for a talk that I was giving on the life of Umar radiallahu anhu, and I just delivered it on Friday in Cape Town at the masjid, and the title was The World Needs an Umar. And Umar radiallahu anhu, when he used to meet business people, he used to say something amazing. He used to say that even if you're making a lot of money, make more money. Now, sometimes in the kind of environment that we live in, we would, gossip and skinner in the corridors and say, look at how greedy that guy is. I mean, he's got so much and he wants more. But the rationale behind the thinking of Umar radiallahu anhu was that when you make money with the right intention, then the benefit is not only to the individual. There's a kind of communal, collective benefit. And when there's financial stability in your family, and there's financial stability in your community, in your society, then that forms the bedrock of stability for the ummah to progress on every other front. When financially you're dependent, then in every other way you're handicapped, because then your progress on every front is dependent on somebody else's financial assistance. So, in the first round of discussion with our panelists, we are going to focus on financial stability and how the relevance of investments in terms of achieving this financial stability is not only at a micro level, but at a macro level. Our panelists will perhaps touch on the macro headwinds which are faced by South Africa and globally, and what investments can and have achieved to alleviate this. We will look to explore the mechanism of how to enhance stability at the micro level, what partnership options exist in the short term and in the long term, how we should think about investments and how we should think about partnership options, and how to start off with the now, and some stories that will resonate in terms of our day-to-day roles. So we will ask each of our panelists in about 3 minutes or so to give us some opening remarks in terms of the topic and their broader thoughts and how it resonates in terms of the role that they play, starting with Amina, inshallah.
Wanted to today is share my insights with regard to investment fundamentals from an M&A and corporate advisor perspective. Okay. I think over my years as an M&A advisor, I've helped my clients to buy a business, sell a business, and finance the business. And I think the overriding kind of aim is always that of value creation. And there's numerous different types of investors, and each have a different objective. Let me give you a few examples. I mean, to start off with, you've got something called a strategic investor. And who is a strategic investor? He's either a company or in many cases an owner-managed business. And what they're looking for is growth and expanding their business. Growth, growing their business, growing their product lines, growing their markets. In doing so, is like kind of eliminating the competition and also achieving cost synergies. And at times, they also look to acquire intellectual property. So that's your strategic investor, and that's very different to a private equity kind of fund or private equity investor. So private equity, who are they? They basically these large investment funds. So when they invest into a business, they look for undervalued assets. They acquire the assets. They look to improve the assets, and I mean they only stay there for between 5 to 7 years. And then when they exit the asset, for them it's about maximizing returns. And at times, a private equity kind of investor, he look for a bolt-on acquisition within his portfolio. Then you have something called a venture capitalist. A venture capitalist is, I mean, as the name suggests, a venture, you're going into like a new venture. It's basically these high growth startup companies. And the only thing that, the first thing that comes to mind is like these tech companies. So they'll inject money into the company. So they inject their liquidity. They'll expand the operations. They'll consolidate a couple of players. And then their role is done. And then they exit the investment. And I think the fourth type of investor that you get is what you call a sovereign wealth fund or an institutional investor. And these investors are normally government-backed, or they're large institutional investor like a pension fund. And their aim is completely different. So they're looking for long-term growth, diversification, and exposure to different industries. Sometimes they'll also look to acquire an asset to secure control over strategic assets. So that's your sovereign wealth funds. And I think the last type of investor, which is your HNWI, these are your high net worth individuals or your family offices. So these are very wealthy individuals that have a lot of money. So the first thing they need to do is preserve their wealth and then grow their wealth, and also it's a legacy for them. And sometimes, what they look for is to monopolize a certain industry. Even if we had to look around in like today's, if you look at the tires and mags, so there's like a family that owns majority of the tires and mags or the garages. So these are like your high net worth individuals. But I think what you need to always bear in mind is that you have different types of investors, and each of them have a different objective, and each of them have a different risk tolerance. But M&A activity is actually, it's equally important to all of them, because the three objectives are like wealth creation, market position, and strategic to get a strategic asset. So I think that's the different types of investors that you have with a plethora of investors.
Jazakumullah for that. Interesting. Ridwan, your opening thoughts?
To yourself and the audience for obviously supporting us with the session today. I think obviously my context is really, I think a lot of what Amina said resonates, given my background, given what we do at the business. Within 274, many would know as an asset manager, you're really seen as custodians and guardians of capital. What we really do is, invest money on behalf of investors, which is, the man on the street, individuals in their own right, or institutional investors. Now, institutional investors, we usually term, large pension funds, but in reality, whose money is it actually behind those pension funds? It's actually the members of individual pension funds, right? So if you look at, the resources or mining sector as an example, there's, a couple of large unions and pension funds that actually, it's the miners that contribute to the pension fund. Those pension funds provide us with capital, and we've got to really serve as guardians of that capital. And I think the important thing to really stress, and one of the key takeaways that I'll probably make up front is really just around strong process and governance. And that's something that I think us as a business within 274, we really focus on driving, knowing very well that it's not our own money that we're investing. And I think with that, we obviously build our business around, ensuring that we've got the right process, ensuring that we've got the right level of governance across, the different strategies that we look to deploy into. Part of what we also see as very important from an investment perspective that, really aims at promoting financial stability is strong collaboration. I think we recognize it, and I think many do, that, you can't just change the world by yourself. What we've done, and it sounds complex when we tell people that, within one of our structures, as an example, we've taken in money from government through the National Treasury called the Jobs Fund. Now, a lot of people hear, getting money from government, Jobs Fund, these sort of buzzwords, they think it's something that's very complex. And yes, there's a very stringent process around being able to get that capital. But in a nutshell, what that's allowed us to do is basically blend government money in the right way that's intended to promote financial stability and business stability, specifically focus on job creation. So what we've done is we've brought in government money, blended it with the money of pensioners, or pension funds rather, and channeled that to investment opportunities in the market that aim to promote job creation. And that's an example of, I guess, the important points, or the importance of investments that drive financial stability, that drive economic stability. I think in your opening remarks, Malana, you spoke about, obviously, we operate in a very cohesive ecosystem, one that needs collaboration, and I think it's something that, is of paramount importance when it comes to sort of investments and making sure that those are done with the intention of stability and sustainability of business and financial sector.
So strong governance and collaboration. Amin, your opening thoughts?
Bismillahir Rahmanir Rahim. I think from my side, obviously being a banker, the lens that we apply is a little different to the lens that Ridwan and Amina would apply from an M&A perspective or asset manager. I think for me, maybe the starting blocks is for us to understand the difference between savings and investing. And oftentimes, I think these terms get convoluted with each other. Saving is not investing. Saving is basically just trying to store your wealth for a particular event or an emergency or something to that effect. Versus investment is you're putting your money into a venture or into something with a hope that it's going to yield you a return. It's like planting a seed and hoping that a tree will grow and grant you shade. So I think that's one very important thing for me, is just to eliminate this confusion that saving is different to investing. And when it comes to savings at banks, I think generally what we will get into some of it into the next section of the discussion. But I think where we see these things from a bank and prudent overall financial well-being is through this idea of balance or wasatiyah. As Mullah mentioned some of the verses in the Quran, Allah subhanahu wa ta'ala speaks about وَلَا تَجْعَلْ يَدَكَ مَغْلُولَةً إِلَىٰ عُنُقِكَ وَلَا تَبْسُطْهَا كُلَّ الْبَسْطِ. So Allah subhanahu wa ta'ala tells us what that balance is. He says, don't be so hoardy or hoard your money or save your money to an extent that you tie your own necks with it. But don't also spend so much or be so reckless with your money that it leads you to poverty. And this is that balance between saving and investing. You can go and take high-risk investments without proper prudence or proper consideration, which can lead you into poverty. And you can be الَّذِي جَمَعَ مَالَهُ وَعَدَّدَهُ, those people that just hoard and hoard and hoard their wealth, thinking that it will last them forever. So this is the balance that I think is important that we need to strike. And as bankers, it's something that we take very deep into consideration when we're looking at big transactions that the likes of Amina and Ridwan would co-participate with in certain types of transactions.
Shukran to all of our panelists for those very enlightening and thought-provoking opening remarks. Ridwan, if I can come back to you, right, in a very specific question. When we talk about the investors and in their various types, as Amina has outlined, what would you advise in terms of how they should think about strategy and how they should align the strategy to objectives that are set to grow their business? What are some of the mechanisms that you would suggest that are used to manage risk when it comes to investment?
A fundamental part of the answer is probably in the question. You use the word objective, and I think it really starts there. We know that investors out there have different objectives. You have different types of investors, which I mean, I explained. You know, the way if I were to simplify it, I would categorize investors really as perhaps twofold: individual and institutional, which is sort of the lens that we typically apply, and then you can go into sort of further granularity as to how that is further stratified or broken down. But it really starts with objective. What is your objective? What are you trying to achieve by your investment decision? And that differs from person to person. Amin sort of made his comment around, you know, the importance of distinguishing between savings and investment. Obviously, speaking specifically from an investment perspective, the point of investment is really to allocate your wealth or excess capital to allow it to grow and hopefully benefit yourself and benefit society in the process. But knowing what the objective is from the onset is very important, and that objective is linked to how do you define your objective? You define your objective by what are you trying to achieve within certain time horizons, whether it's the short term, the medium term, the long term. Within each of those, a very important point is risk and return. Now, there's generally, as asset managers, and I guess as the financial services sector in general, there's a risk and return spectrum in terms of what would you allocate your money to. Generally, the most least riskiest investment opportunities rather, would offer the lowest return. Those are typically categorized, you know, such as fixed property, where it's something tangible that you're allocating your money to. You know that the likelihood of losing money on that is perhaps lower than investing into a startup venture that maybe Amina spoke about, which is a lot more risky but offers a greater return. And I think as an investor, knowing what your objective is, whether you're investing your own money or, you know, like us as 274, whether it's the money of our clients, we are custodians and guardians of that capital on behalf of others, it's important to get that balance right. And I think within that, obviously, there's further granularity that one would get to. You know, diversification is another absolutely important point in thinking about risk and return, right? You often speak and hear the term not putting your eggs in one basket. How do you decide which baskets to allocate your eggs to? And typically it's about thinking about what are the options that you have out there, and what are the risk and return factors behind each of those. The risks that I typically think about, you know, within our business is things like liquidity risk, right? People often attribute risk to what is the risk of me losing money, but there's other types of risks that are important for investors. How easily can I access my wealth when I place it with, you know, investing it in a private venture that needs money? I may not be able to sell down. Investing in property, while it's safe, it offers lower liquidity as opposed to placing your money in a listed Sharia-compliant equity fund, where that money is then allocated to Sharia-compliant listed stocks, which are a lot easier to liquidate and access that wealth. So those are important aspects that I think I would encourage the viewers to take away around, you know, what are the fundamentals of thinking through their decision to make an investment. So it's risk and return, diversification. I think process is very important. Due diligence, you know, before making any investment decision, just really taking the time to do research, you know, looking at what is the nature of where your money is going, what is it actually going to be used for. If you're investing in a new venture, you know, if it's a restaurant opportunity, a new restaurant that's coming up in the area, and that, you know, you've got a buddy that, you know, says, will you invest with me? Thinking about what are the risks behind this, what is the competition, just thinking through that, you know, and using, you know, the word the statement I made in my opening remark around collaboration, you know, just leaning on people in the industry, whether it's friends, family, reaching out to experts in the field that might have insight into certain aspects behind an investment decision that you might not have thought about is absolutely important. Now, I think my closing remark is, I think a lot of our viewers and our audience, I suspect, is also, and is aimed at or we aim at targeting sort of SMEs and businesses. And they may say, look, I have money in my business. I don't really want to invest it out of my business. How should I view my decision then? And I think I don't want to get too technical from a theoretical perspective around how to think, you know, using buzzwords like return on investment and IRR and all these fancy things, I think, which is important. I think the important point that I would bring that type of listener to or audience member to is, again, diversification. And what I mean by that is, if there's a businessman or businesswoman that has a business that has generated excess wealth, what are the options? The option is either to reinvest back into your business to grow your business, which comes with risk, but obviously the potential for greater returns. But it's also the point of diversification. thinking about where is my business going, what are the things that are outside of my control within the industry, whether it's the market, whether it's a president in a foreign country making a comment that impacts, directly impacts your industry because potentially your supply chain is global, and thinking about potentially shifting some of your eggs outside of your business into other asset classes that may not generate the same level of return that you can within your business, but allows you some level of diversification and thereby balancing that sort of risk and reward spectrum.
So, early on you spoke about the different types of investors. Right? Now, looking at it from the perspective of business, how would you advise that businesses should think about bringing in external capital, especially when it comes to equity investors? Because there's this prospect of dilution of your own shareholding. You're bringing in new partners, and now you're no longer the boss. You've got to kind of share decision making. You've got other role players that you are bringing in. So the money is coming in, but obviously with that, there are, so to speak, strings attached.
Definitely. So I think from where I come from, we deal with a lot of family-owned businesses. And I think family-owned businesses, a lot of them shy away from mergers and acquisitions because, as Mulana said, they're very worried about dilution. But I think, what we try to tell them, and what we've saw, like with all my the clients that I have, is like when they embark on this M&A journey, it's either about growth, helping them to survive, or like many family-owned businesses, you don't have that succession planning because sometimes the kids don't want to take over the businesses. So you have this transition from one generation to another. So in M&A, if your kids don't want to take over your business, you're going to have to sell your business. So and why should businesses be open? Okay, first of all, they're getting extra liquidity. It's the cash. But then they should also think about the softer areas, and it's the expertise that a private equity or venture capitalist or somebody's bringing to your business. So the way I see it, like you break it down into three kind of silos. It's the expertise, the networks, and strategic long-term growth. So let's unpack each of them. So when you talk about expertise, so these private equity investors or these venture capitalists, they run a whole lot of investment companies. So they do this on a daily basis. So they have the intellectual ability and the operational know-how, and they can help you with decision making, because sometimes as an owner managed business you get so stuck in your business that you can't actually see the bigger picture. So you just need somebody to kind of guide you, and so it's that expertise that somebody will bring to you. And also with regards to if I look at the owner managed businesses that we do, they're not like a professional environment. So if you look at their financial reporting, they need a hell of a lot of help with their financial reporting. They lack governance. So with bringing somebody on that has this intellectual ability and the credibility, they kind of professionalize your business. So you have the expertise, and then the network. So when you're dealing with these private equity players, they're highly connected people. So they can introduce you to new customers, new suppliers, new outsource partners. If you want to go to international markets, they can help you with regards to your hedging strategy. You need to our rand is depreciating most of the time. So how do you kind of, counter that? So they can help you with things like that. And as your business grows, you need talent, and they can help you to bring that top talent into your business. So, that's the networks. And then the third thing is help you through like long-term strategic growth. So if I had to look at my client portfolios, which are like the Nedbank private equities, the RMB private equities, the Standard Bank, so what they do, like when we had COVID, so most of the investee companies, they deploy their time and their resources to help the investee companies survive. So that's surviving an economic downturn. So it's not only the capital that they can bring, they can also bring like a wealth of experience. And I think things that you should consider before you bring somebody on, it's like a marriage. You need to think about the culture, the vision, the values. You need commonality. You need to be clear on the purpose. Are they just going to be a silent partner? Are they bringing in capital? Are they bringing in intellectual property. So you need to be clear on the intention. And then again, the ownership. I mean, are you selling a minority stake or majority stake? So you need to be clear on that. And then the responsibilities. Are you still going to run your business? The day-to-day operations, is that still going to be run by you? Who makes the ultimate decision making? And then, I mean, like everything, you're going to have conflict. So what about when conflict happens? Do you have conflict resolution mechanism? And I mean, if they want to exit, if it's a private equity fund, they're going to exit after 5 or 7 years. So is there an exit mechanism? But I think and then maybe even after you exit, what about the intellectual property? How do you kind of deal with that intellectual property? But I'm saying all of that, I mean, when you're embarking on this M&A journey, you need to bed all of this down, and it's basically, you have to have these watertight legal agreements. So while it is exciting, there's a lot of work behind it. I mean, you have to think about the legals, the commercials, but as I said, M&A activity is a power tool for growth.
I like the analogy of marriage. So, I mean, people generally complain that all of this sounds good in theory, but the banks don't want to come to the party and assist with financing. I mean, what's your message to the audience in regards to the kind of appetite that the banks have and the limits, and what are the opportunities, especially for small and medium enterprises, to utilize Sharia-compliant financing options to achieve growth?
I'm so grateful that a question came up, because this is such a bad misconception, and I think people don't understand in general terms, and I'm making a generalization, what a bank is. And essentially what a bank is we a vault for customers' money. And if you think about you as an individual, you would take your life savings and you would put it into a bank. Or a pensioner would take their money and put it into a bank. A grant recipient. People that are just trying to get by are taking their money, the 100 rands and 1,000 rands, and puts it into the bank. And what they expect from us as a bank is to keep that money safe. And if I were to ask anybody in the audience or online, if you came to me and said to me, here's my life-saving 1 million rand, keep it safe for me, would you want me to give it to Joe Soap Barbershop on the corner of the street that doesn't have a customer yet? And this is a concept that many people don't understand, is that banks are a particular player within the funding continuum. And it's important for us to understand, the first thing that you need to understand as a business is where you are in your life cycle of a business. If you are at startup, then you have a particular funding mechanism. If you are in growth phase, there's a particular funding mechanism. If you are large and mature, you've got a separate funding mechanism. So banks deal with large, mature businesses. This is called senior debt in technical terms. What senior debt is, we look at cash flow stability. So are you a business that can provide steady cash flows that can generate a repayment profile for a loan or facility? Because remember, on the other side of that loan is a depositor. I need to give that depositor their money back. So if you can't give me cash, I don't have anything to pay my depositor back. So this is where banks play. Banks play in the arena of businesses being able to generate stable cash flows on a continuous basis. If you are in growth, your structure that is known is called mezzanine. What mezzanine is, it's a hybrid instrument somewhere between equity and senior, where it comes in the form of a loan, but it has a repayment profile like equity. So you're allowing the investor to get a little higher return because you don't want to dilute your equity. But then that investor or that provider of the funding has the ability to take equity in their business in the event of default or whatever. And if you are at startup, and as hard as this thing is to hear, if you are a startup business, your funding mechanism is equity. You need to go to friends and family, you need to go to seed funds, you need to go to these angel investors, and don't be scared of sharing the pie. This is the biggest thing that we see as banks, is you at startup, you've got not 1 cent of revenue, but you're complaining of sharing. And the analogy that we always use is 100% of nothing is nothing versus 80% of something. So that's, for me, a very important thing. And this notion that banks don't want to come to the party is not true. I mean, if you look at all of the major banks in South Africa, Standard Bank as an example, we've got 3 trillion rand in loans. We've lent out 3 trillion rand into the market. The FNB probably around 2 trillion, ABSA probably around 2 trillion, NEDs around the same part. So it's not that the banks are not coming to the party. We've put in nearly 10 trillion rand of surplus liquidity into the economy. It's how do you access the right funding mechanism based on where you are as a business. If you're a small startup, you're not going to get bank funding. So it's important for businesses to understand where you are, what you are, and what your funding mechanism needs to be.
Interesting indeed. All right, so we move to the next round now, and it's kind of like closing thoughts, but specifically on the topic of ethical and sustainable investing. We hear these terms, but what exactly does it mean? What are the different connotations, and how does it impact on the topic of discussion at hand? I think we'll go in reverse order, so meanwhile you have the mic.
Yeah, I think for me the interesting thing about this whole ethical stuff, and obviously I'm an Islamic banker, so the lens through which I see things is generally, and I think all of us should as Muslims try to see the world through an Islamic worldview, is this concept of ESG starting to become so pervasive in the world. I think for us as Muslims is not something new. It's been embedded within the fiber of Islam since the dawn of Islam. Allah subhanahu wa ta'ala says, Kuntum khayra umma ukhrijat linnas, ta'muruna bil ma'roof wa tanhawna 'anil munkar. We have raised you as the best of nations. In my understanding, to be of benefit to humanity. Ukhrijat linnas. Ta'muruna bil ma'roof, you uphold that which is right, wa tanhawna 'anil munkar, and you forbid that which is wrong, wa tu'minuna billah, and you have the consciousness of this greater power of Allah subhanahu wa ta'ala. So for me, this idea of ESG or ethics or social governance or sustainability or governance has been institutionalized within Islam 1,446 years ago. And if anything, I think it's Islamic finance's role in the broader world that has actually prompted the global finance industry and other places to actually start making ESG principles more applicable within that. So I think as Muslims, by default, we run everything we do in an ethical way. Quran tells us to have just measure when you're dealing with your clients. We must have balance and all of these things. I think the Western capitalistic machine have only chosen to institutionalize it now. So for us, these are not foreign concepts. These are concepts that come to us easily, and it's just a matter of us putting it into a fit-for-purpose mechanism, depending on the size and complexity of your business.
Yeah, it's always difficult to follow Amin when he sort of quotes Quran, inshallah. But yeah, I think obviously, the alignment between ethical and sustainability investing, with that which our deen teaches is evident. As Amin put it, it's something that is innate in our belief system and everything we do. But I think what I would probably leave the audience with is, as a layman or laywoman investor that's thinking about, whether it's for your business, how to allocate excess capital, or whether it's, in your own right, where to allocate that excess capital to. A lot of, if you are investing in a listed stock market through a 27/4 or other fund option that is out there, a lot of that is going to, large listed corporates, because again, when you think about risk and return, the risk associated with a large listed business is often less than, investing in something that is unlisted or private, like Amin mentioned in his previous touch points. But what I would mention is also just thinking about, particularly where it's investment and a decision linked to your own business, whether it's to grow your business, whether it's bringing another shareholder involved, whether it's selling part of your business and thinking about who to bring on. Even if you're selling your entire business and there's an entirely new shareholding, yes, you are wiping your hands clean, so to speak, of this what was once your baby, that you had grown. But obviously there's a much wider stakeholder community that you leave behind. And I think Islam promotes obviously well-being of not just oneself, but the society. And those stakeholders are, things like co-shareholders. Those are employees who depend on you for their livelihood every day. If you obviously sell your business not knowing what a new buyer is going to do, yes, it's not necessarily your entire responsibility to make sure the business is still run well, but it is something that I believe is the responsibility of a seller or an investment or divestment decision maker, is thinking about what is the wider ethical and sustainability impact on the wider community, which includes suppliers, customers, as I said, employees, my co-shareholders, because obviously your decision, even though you sometimes don't see it, has a much wider impact beyond just obviously yourself, your immediate family. It's an entire ecosystem that you had traded with on a day-to-day basis for a long time. And that's probably the thought that I would leave behind, which again comes back to what Amin spoke about in terms of its alignment with what Islam really promotes and wants from us.
Amina, we give you the last word.
I fully agree with Amin because, he said the Western capitalist. So from where I sit, because we deal with all these corporates, you look at the large companies like Ramgrow in that they're scurrying for ESG investments. And it's actually... we're so busy with looking for ESG investments for them, and all that they want to do is try to align the ESG investments with their financial goals. And so ESG is like this new buzzword. And I think, from my perspective, if you kind of invest in this company that positively contributes to the planet, to society at large, that's in amana. And I think we all have that responsibility. And if I have to think about it, these companies that have these good practices, they have lower risks. So they don't have those reputational risks of like polluting the rivers where communities are around, or mudslides or anything. So they have like a lower risk. And with that lower risk, I think you have more stable returns. And when you have more stable returns, you can weather the storm in an economic downturn. And things like if you're a company in an economic downturn, the first thing that you do is lower your cost, and you cut your payroll costs. So you're adding to the unemployment in the country, and we already have a 32% unemployment kind of rate. So for me, looking at these companies that positively affect our planet, I think that's like really, really good to invest in. I think my final thoughts is that without a doubt, like M&A activity is a game changer. You can grow your business, you can unlock wealth, you can professionalize your business. But the most important thing is you need to carefully consider who you partner with, because you need to have you need to be aligned with regards to vision, culture, and values.
So Jazakumullah to all of the panelists. As a radio man, I think I have to compliment all of you in terms of time. Spot on. This morning I was interviewing a professor from Malaysia about the Trump's tariffs on steel and aluminium. And we're up to the half-hour headline. And I was trying to nudge him to close. And every time I'm nudging him that, we're going to wrap up, he's like, I just have to tell your listeners one more thing. You must hear this one more thing. So, no, Jazakumullah, a really insightful perspective and really enlightening and thought-provoking and on time. So we come to the last part of the program, and that is where we hear from you in terms of the Q&A. I will ask you, if possible, to come to the front just for the virtual audience so that, they can hear you. These mics are for the virtual audience. And when you come to the front, just maybe introduce yourself and then pose your question to the panelists and mention to whom specifically you are posing your questions. Rania, I don't know if you want to go first.
It's a bit of an unfair advantage because I was involved in arranging the event today. But I think what I want to ask is, and especially since we've touched a lot on Sharia investing, I always felt that you guys had it right before ESG became a big thing. With the recent developments in the surgence of AI, how do we implement AI but still, when we look at mergers and acquisitions, when we look in investment allocation, when we look at banking sort of products and stuff, how does that surgence of AI be implemented in a Sharia compliant manner? That's pretty much my question.
DeepSeek. Who wants to go first? Anybody want to take first bite at this question?
So I think there's been lots of discussions. Personally, I've read a couple of academic articles around AI bias. They're trying to solve AI bias within gender. We got an AI specialist here, so we must ask her to answer the question if you actually need deep AI knowledge. But personally, I don't foresee it as, remember, my simplistic understanding of an AI engine, right? It's an algorithmic tool that will get trained on a particular set of rules. And if you look at what Sharia banking is, it's a set of rules. You've got a qualitative screen and a quantitative screen. So if you look at Ridwan's universe as an example within asset management, right, you can train that tool to say, listen, here's IOFI's quantitative screens in terms of debt to EBITDA ratios or interest income ratios, non-permissible income ratios, gearing ratios. You can train that engine can go through to every exchange across the world, extract the financial data, analyze the quantitative screen, and then do that. And on the qualitative screen, it's really easy, right? You've got a sectoral exclusion on a defined or a finite list of industries. And I think the core principle that we apply generally from a Sharia perspective is that the default position is that not everything is haram until proven halal. It's the opposite. It's everything is permissible until we know that it's explicitly forbidden. So I think, like any AI engine, right, you're going to have to train that tool in the beginning. You're going to have to feed it with data. There's probably going to be errors in the initial days, but as it gets more intuitive and it learns more from data, the more we feed it with data and correct it, I think eventually there would definitely be a tool. We've seen in some on the personal side, we've seen some robo-advisory tools being deployed on Sharia-compliant personal investments. So simple sort of tool, you go in, you put in your investment profile, that the robot would determine what sort of risk grade you are. It'll put forward a bunch of equities and stuff. So we're starting to see it come through, I think at an advanced level in some of the advanced modeling and stuff that you guys use with cash flow forecasts and asset valuations and stuff. I think there's still work to be done. We probably need to define a set of rules, but I think it can be done. My personal opinion, I don't think it's something that can't be achieved.
Ridwan, you want to add, or you good?
I mean, I think I can talk about AI from a Sharia banking or an asset management kind of perspective. So what I look at it is AI from what I do, which is like evaluating the risk in a company. So I mean, AI is becoming more prominent. I mean, there's numerous tools out there. I mean, there's things like simple tools. You can use a Power BI. I mean, we do, and you can even do a lot in Excel, but you have to be really clued up in Excel. But I think from like my perspective, I mean, we are using more AI tools to make what we do kind of easier. So it's all about data-driven insight. So when we do go into a company, I mean, we look at the company and we kind of break down the data. We analyze the revenue to death to understand what are the revenue drivers, the cost drivers. And I think when I started off in my career, we used to do that all manually in Excel. And I mean, it used to take us time, but now we do have data-driven tools to help us to analyze a company. So AI is making my work a bit easier.
Jazakallah. Yeah, I think, Rindy, I mean, I don't want to labor the point too much. I think what my co-panelists have said, absolutely spot on. I was tempted to take out ChatGPT and ask for an answer for the question, but I held back. I think you know, to sort of round up both of what they said and summarize it, and maybe leave the audience with a different perspective on it. And I won't take credit for it, because I actually came across this in a podcast I was listening to on AI. But it's really an enabler, right? It's an enabler of processes, efficiency, and I'll get into a second what that can potentially mean for humanity, for the world as we know it. I think the one point specifically linked to the area of Islamic finance whether it's banking, asset management, or other, is the importance of governance and your Sharia board, which is a very crucial aspect of any Islamic finance institution in taking their guidance on new developments. I think it's well known, but the 4 sources of guidance on Sharia is really, firstly, the Quran, Sunnah, but after those 2, which obviously have limitations in terms of it being finite from our perspective in the way that we understand it, there's also the element of analogy and discussion between scholars, right? And I think that we rely on the scholars tremendously to help us as practitioners understand and blend today's concepts of finance, banking, advisory with the principles of Sharia. So I think while AI enables obviously these elements like efficiency, enhancing productivity, or whatever it is within your process, whether it's bringing a new product, I think leveraging and holding onto those strong governance structures are important. I think the point that I wanted to actually leave the audience with, and the perspective from a Sharia perspective is, and this was what I heard on a podcast, is, there's a view that in AI being an enabler to help efficiency, it's likely that, there'll be obviously less need for human labor, and potentially will be a global sort of grant that will be required because people won't have work. There'll be, robots will do it much faster, or AI will do it much faster. But the interesting part, or the profound and possibly dangerous part of that, is what does that do for the meaning in people's lives? Because a lot of people derive meaning and purpose by who they are, right? We work, most of our time in our day is spent in our jobs. And if that's taken away, what does that mean for people's purpose, for contentment levels? Because that's where you derive your sense of purpose. And I come back to obviously what our deen, what Sharia says, what religion tells us, is obviously finding a greater purpose beyond just this world, and which is obviously the year after, and striving to what has been shown to us through our deen.
Do we have any other hands for questions and comments on the floor? Okay, could you come to the front? Anybody else? We'll just take all the questions and comments and then ask the panelists to answer, and then we'll wrap, inshallah. Come to the front. Just introduce yourself and look towards the camera so the virtual audience can also benefit. Yeah. Assalamu alaikum.
And I had, I don't know if you still remember, 2018 November, I came to Standard Bank for Sharia financing. And I was trying to set up a venture where we could have a public float basically for a Hajj and Umrah product, where we own the asset base of the aircraft, the hotels and all the other stuff. And I won't forget what you said to me. You said to me, it'd still be risky because it's a hotel and a couple of other issues that you looked at. And I said, well, it's a Hajj and Umrah. Everybody's got to go on Hajj and Umrah. Little did I know that 2 years down the line, in 2020, we would have the COVID virus. And the COVID virus basically brought your prophecy, if I can call it that, to fruition. So that means nobody could travel, and that would have been basically the end of Hajj and Umrah operations. So if you had any investments, you could have had a problem with it. So I got to thank you for that. However, having said that, I think the world has moved on now and realized that if you shut down an economy, you're going to have more people dying from the shutdown of the economy than the disease themselves. So I don't think this is going to happen again. I think you're going to find more people dying at the next event. So I was bearing that in mind now, have you changed your position on the risk profile now of a Hajj and Umrah product? Because I see that you've got $5 billion worth of investments that you're managing here. And we have a program, and we're busy with the Saudi South Africa Council. I'm on the tourism and hotel section, and what happens is in there, we're looking at two-way investments.
Yeah.
So would you be prepared to come on board as a bank and as 27-4 to put some of your expertise into this matter and see if we can maybe in 2025 set off on this new goal? Thank you.
Shukran. Come forward.
Assalamu alaikum wa rahmatullahi.
Assalamu wa rahmatullah.
My name is Yusuf Daud, and I just have a question for Mohammed Amin. I mean, I think it's generally to all the bankers in this country. in terms of Sharia compliance. I've got a real bugbear, okay? So I'm going to personalize it and say it's not a business thing. Let's say as an individual. If I came, this is a very important question, Marlon, just listen to it. So if I came to you as an individual and I said I got R1 million, which I want to invest, and I'd like to put it into a living annuity. So there's regulatory compliance, there's governance, etc. I'm finding that there's a Sharia gap, because what do you do with that money? That money, all the banks I've spoken to, they would take that and put it into an interest-bearing account, a riba account. I mean, I'm sorry, and it basically...
Just repeat the question.
So, the conduit of taking the cash that I provide you into an investment account, where does that go to? What is the conduit for that? Because I'm finding that the answer I'm getting back, it goes into an interest-bearing account, which then I've got to get a recon on and clean my account up. And what really worries me is that all the banks have pretty much the same Sharia control board and the same individuals, and you'd go and say, you'd sell the product and say, we have a Sharia compliant board. But the Sharia compliant board perhaps needs to look in more detail to the conduit of how the fund is getting to the final investment. And to me, there's a Sharia gap there.
All right. Jazakumullah. Any other questions or comments from the floor before we give the panelists an opportunity to respond? Okay, I mean, you can go first.
It's like I got the hot seat, all the questions are for me. So I think, Marv, the first question on the living annuity, just for clarity, it's not a banking product. The banks have no control on living annuities. It's categorized as a life insurance product, and it falls under the Long-Term Insurance Act. So the asset managers are custodians of that product and the processes associated with that product. So the bank account that manages that product is not our bank account. It's a bank account that's controlled by the life insurer. And so the simple solution is the life insurer needs to have a Sharia compliant bank account. So it's a process that obviously we as banks are trying to run with life insurers across the board. But some life insurers have come on board, that I can tell you. But obviously some of the other life insurance haven't come on board. So I think just for clarity, it's not a bank, although it's a bank account that's held with us as bankers, the decision to convert that bank account to a Sharia compliant account vests with the life insurer. I take the point, and it is true, that the clearing account of that is at some times a interest-bearing account. I think importantly, and this is something that many of us forget or take for granted, is Muslims in South Africa represent 1.2% of the population. The assets under management within the normal universe is nearly 25 trillion. The assets under management within a Sharia environment hasn't yet reached 100 billion. We are rounding error in the broader system. So for us to fight, we're fighting against a behemoth and asking them to change it. And a lot of these accounts that you speak about, the conduit accounts, are actually regulated accounts by FSCA. So the Financial Sector Conduct Authority provides you with a certain category of accounts, and many of these accounts have been hard-coded through the insurance system. So it's not as easy as saying, go change a bank account. It's actually trying to get a life insurer with 250 billion rand of assets under management and cash flows to change a bank account number with a million and a half clients. So I acknowledge the point. There's progress that has been made, but we sort of a minority grouping that we're trying to do our best in and navigating through that universe. And then the second question, I think it's difficult for us to say whether we're in or out of something without having analyzed the deal, right? So I can't say yes or no whether we're in or out. Happy to engage further on a more detailed basis. Sounds like something more up Ridwan's alley than it is mine, but happy to have a meeting between Ridwan and myself to see whether it is a project that's of merit and either one of us would look to fund.
Okay, we've got 2 minutes left, so Ridwan, you can take a minute each and add if you want to the responses to the two questions.
Yeah, I think, I mean, nice job at handing both questions onto the asset manager. But no, I think what you've said is 100%. It's spot on. I think to the second question to Brother Esop, we actually seen it also similarly on a different product which we've got in the market, which is our Sukuk. And because that's sort of listed on the JSE, it's one of the few. They call it it's a debt-like product because of its characteristics. It's part of the debt segment, even though it's a Sukuk. And when a profit is paid out, where that profit is held, if the client doesn't actually pull it out, it's interest-bearing. And we've tried to engage the stockbrokers who actually manage that with the clients and say, can we change this? But they've told us it's actually a JSE thing. And when you think about the JSE and the volume and value of products, equities, or debt-like products that they've got listed, and you sort of compare our Sukuk, which is, it's a rounding error, as Amin says, but it is something we've looked at. I think as an industry, as Amin says, we're making strides slowly but surely, and it is something, I think we're happy to have a discussion offline and see if this is something we can specifically look into as to whether, we can support with it. And then I think I'll echo what Amin said as the response to the first question. Difficult to respond immediately, but absolutely willing to have a discussion and see whether it fits a mandate. And I think, to one of the key points from this discussion is we both, as bankers and asset managers, are governed by mandate and whose money we manage, which is not our own. And, because of that, there's process, governance that we've got to go through, but willing to engage and see if there is something here that we can either fit into, or whether the bank or the asset manager has appetite to, to help take forward. Inshallah.
Amina, you have anything to add? Are you good? MashaAllah. Well, it's 7 o'clock on the dot. I don't know, time for the news. No. Jazakallah to Amin and to Ridwan and to Amina. I think we leave here, all of us, enriched, understanding certain concepts better, and thinking, I think, a little deeper and wider about a number of issues. And we will have a networking session after the Salah break, and then have some refreshments. And there's ample opportunity thereafter to network and to engage further on the points that were raised. To close, I'll hand over to Rainier on behalf of 27-4 to share some concluding thoughts on their advisory services and do the official thanks to the panelists. After that, like the Salah is in those rooms there, there's a space for Salah there, refreshments at the back, and then networking, inshallah. Jazakumullah to the online audience and to those physically in attendance today for your participation.
So I've got the shortest speech of all. So I'm the Managing Director of 27-4 Advisory Services, where we look at individual planning, corporate consulting. We help manage what we do here in terms of financial education. And we just want to thank each and everyone that came through tonight to come and listen to the panelists. And then I want to extend a heartfelt welcome or a shukran to each of our panelists and our moderator for actually joining us. And then another warm thank you to Radio Islam for actually just making this a live event as well. So for each of the panelists, bar Ridwan, because he works for us, we have given you a present just in time for preparation for Ramadan. And we thank you for your time here, and we look forward to having another event like this in the future. Okay.